Welcome to Slating the Safe Exam to 57 high priority safe exam mortgage terms 19 through 26. My name is Rich Leffler, and I'm the senior instructor and founder of Accelerated Development, where we have been successfully preparing safe exam candidates for this exam for over 17 years. And now some ARM terminology that you really need to know. Index. The index is a benchmark used to determine changes in an ARM's interest rate. It's the component of the ARM that's responsible for interest rate fluctuations. There are numerous indices that the lender can select when offering the ARMs that it does. For example, the Secured Overnight Finance Rate, the T-bill, the Freddie Mac 3060, the Fannie Mae 3060, the prime lending rate. The leverage lender is typically not responsible for selecting the ARM's index. The margin is the lender's and investor's profit and operating expense. Like the index, the margin is established by the lender at the ARM's point of origination. The fully indexed rate, also referred to as the fully indexed accrual rate or FIR, is the rate that the borrower pays after the conclusion of the loan's initial period of interest rate stability. To calculate it, simply add the index plus the margin, and there you'll have the FIR. The initial rate or start rate is the rate at which the borrower's payment is established during the ARM's initial period of interest rate stability. It's like the bait used in fishing. It's the lower than market rate that attracts the borrower to the ARM in the first place. You can have a start rate that's either a discount or a teaser rate. The periodic adjustment cap, PAC, also referred to as the periodic rate cap, PRC, two names for the same thing. This is the cap limiting rate adjustments from the second through the last adjustment. The cap that limits the initial adjustment is called an initial adjustment cap, or IAC. Typically with conventional mortgages, you will have an IAC as the first cap. However, in VA, USDA, and FHA ARMs, there are typically two, not three caps. In that case, the periodic adjustment cap will also act as the initial adjustment cap. Life of loan cap, or LOLC, is the cap establishing the highest rate to which the ARM can ever adjust. It is the cap that's used to determine and calculate the ARM's worst case scenario. The payment cap, or PC, is a generally obsolete cap that limits the highest amount to which a payment can rise regardless of for what the loan's interest rate otherwise calls. A payment cap can result in negative amortization when the maximum that the borrower is required to pay is less than the amount that covers the interest because the interest rate calls for a higher payment amount. The borrower pays one amount even though they should pay a higher amount. So the difference between what they pay and what they should be paying gets added to the balance of the mortgage. That's called negative amortization, deferred interest. And finally, the adjustment period is the frequency at which the ARM's interest rate changes. Now, if you happen to be interested in a video through which I go into adjustable rate mortgages in far greater detail, please look in the description where you'll find a link to that video. If you happen to be looking for additional products or resources to otherwise help you pass a safe exam, you got your back, Jack, when it comes to preparing for the safe exam. Good luck.